Hello, and welcome to the Logistics Management Podcast. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Avery Vise to our podcast. Avery serves as Vice President of Trucking for FTR Transportation Intelligence, a forecasting and data analysis firm specializing in freight transportation. Avery has closely studied the transportation sector for nearly 35 years as an editor, analyst, and researcher, including more than 20 years dedicated to the trucking industry alone. Avery served as executive director of trucking research and analysis for Randall-Reilly from 2011 to 2013 after a decade as the chief editor of the company's Commercial Carrier Journal. Before joining FTR back in 2017, Avery held several positions related to the trucking industry, including manager of public relations for Volvo Trucks North America and principal of his own transportation consulting and market research practice. Prior to beginning his involvement in trucking back in 1998, Avery covered the commercial aviation sector for 13 years as a reporter based in Washington, D.C. Avery, welcome back to our podcast.
Thanks, Jeff. I guess we still have a little bit of time left to talk after that long bio.
Well, you're fairly accomplished. What can I say?
Thank you.
So let's just jump right in here, Avery. Why don't we just start basically with the current state of the freight economy? In other words, how current macroeconomic conditions are tying in or relating to trucking. We think about things like retail sales, industrial production, inventories, inflation. I mean, there are all kinds of stuff we can address. I'll leave it up to you to kind of
Sure.
get the ball rolling there.
So, there's one sector that's doing pretty well, and then the rest of the economy is kind of treading water or worse. So, uh, the industrial sector has been recovering. I wouldn't say it's, going great guns, and
Hmm.
certainly it depends on which indicator you look at. The last couple of months, the ISM index certainly has indicated a lot of strength. But if you look at the Federal Reserve actual industrial production index, it's, okay, it's growing. Certainly better than it was a year ago, but that's not a particularly tough hurdle.
Hmm.
But, at least until the most recent data, looked like inflation adjusted manufacturing orders were strengthening. And so, I would say that the industrial sector probably spurred on a little bit by the budget reconciliation tax relief, last summer is in, some degree of recovery, which is extraordinarily important for trucking because, except for that short haul freight that I think, that typically moves in dump truck, manufacturing is really the driver of activity in trucking, more so than even consumer spending
Right.
or housing. Speaking of those two, consumer spending is just kind of there, and that's really overall. And if you kind of take out the services sector, it's really been fairly weak. It hasn't, plummeted, and we don't expect it to plummet because it typically doesn't do so unless we're in a recession, and that's not our outlook.
Hmm.
And then the housing market just cannot get a footing. You have a month or two where it looks like, okay, it's going to turn. It looks like, mortgage rates are going to come down below 6% and keep going, which, we think is an important psychological threshold. And it just not, doesn't happen. And so housing market's not good. The consumer sector is just kind of treading water. The one area that I talked about housing, but there is some strength in construction that is data centers. Data center construction is rising and it continues to do
Hmm.
so. And there's still a lot of money being spent to build manufacturing facilities specifically for semiconductors and other kind of high-tech electronics. Now that there's less of that being spent every month, but it's still quite a bit of money. So those are factors I think that are helping, the flatbed sector. Data centers are, a big generator of flatbed freight. A lot of large structural items to move. Just sort of big stuff that's got to be moved. Typically, not as much in, that you would see in dry van. But there's really there's really not a lot of other strength there other than, as I said, a little bit of recovery in the industrial sector. But as I said, that's an important sector for trucking.
Okay, great. That's a great overview. Um, and from a volume perspective, Avery, you look at sort of some different metrics there, like we all do. There's the American Trucking Association's monthly tonnage index. There's obviously straight import data from a whole number of sources, which obviously carries over into trucking, if not quite apples to apples. But how do you sort of look at uh things, let's just say year to date, nearly 3 months into the year? It's hard to believe that Q1 is almost over as I say that. But how would you address or assess the trajectory or lack thereof of volumes, both from the LTL and truckload side? And then maybe as a follow-up, we can look at sort of each market in terms of the conditions overall. In addition to the great overview you just provided on the freight
Sure.
economy, of course.
So, to be frank, number one, we have our own sort of way of estimating volume using our Freightcast model, which is an econometric model. So using all of the things we just talked about,
Yep.
industrial activity, housing, consumption, and so on. Um, and also to be frank, we don't really track from a volume perspective, we don't typically track truckload versus LTL very closely. A lot of analysts do that because obviously there's a lot of large publicly traded
Yes.
LTL
Yes.
carriers. So I'm not too close to that, but I will say that in general for both of those, um, we're doing okay year over year, but year over year is a fairly tough comparison because the first quarter of last year was a strong quarter. Now
Hmm.
we think a lot of that was a pull forward effect related to the expected tariffs coming
Yeah.
in. So not only bringing in a lot of stuff that had to be distributed at least to a warehouse, if not other places, but also bringing in some stuff and since we got it anyway, we might as well produce it and store it. Q1 was a pretty good period last year. So we're not doing all that great this year in Q1 year over year, but
Yeah.
but that's because last year was pretty good year over year. So as the year goes on, we do expect um, overall volume in trucking to be up about maybe 1%, but that includes that short haul freight that I talked about earlier, and
Hmm.
that's not looking good. And so if you look at really the more kind of the over the road sort of distribution equipment types, dry van, refrigerated flatbed, so on, those are doing better. Essentially dry van and flatbed, we are forecasting at this point around 2% growth, which, might not sound like a lot, but we haven't had 2% growth in what, 4 years at this point.
Yeah.
In fact, we haven't really had more than 0.5%, I think, in hardly anything. Refrigerated right now is trending also around that area, although the food volume outlook is kind of tends to be a little more volatile
Hmm.
than some of the more structural things that are durable goods. So that tends to not be as stable of a forecast in terms of volume. But
Understood.
overall, we do expect this year to be better than last year. However, we do expect that to be backloaded for the most part. So in other words, around May or June is really when we start to see whatever acceleration we expect to see. And frankly, we expect next year really to be a stronger year overall than the current year in terms of volume.
Okay, got it, got it. Interesting. Let's shift gears for a moment, remaining on the trucking path, obviously, but let's look at the capacity outlook. And the reason I bring that up, is just because there's been a lot cooking, especially of late on that front, coming out of DOT, FMCSA, etc. When we talk about things like the English language proficiency, crackdown on the so-called CDL mills, as well as the non-domiciled CDL actions being taken too. I mean, there's a lot. I mean, that's probably only part of the puzzle there. But there's a few high-profile capacity reduction efforts or initiatives that have been undertaken of late, and it'd be good to get your take on that. And then just also talking about the capacity outlook as you usually do when at industry conferences and things like that, when you always provide a really good outlook into current utilization rates and where
Sure.
things were or where they're headed, et cetera. So why don't we stick with that for a bit?
Okay. Well, let's start here, which is, everybody's focusing on English language, non-domiciled CDLs, CDL mills, tightening up the standards for electronic logging devices, all those things,
Yeah.
especially the first two, right? That's where the heat is. That's where, obviously the administration politically is in most invested.
Mm-hmm.
But the reality is, yes, those are going to pressure capacity, but capacity is already tight and was already very tight even before all of that started. So, I think when people ask me that question, those are going to, exacerbate, I guess, from the chipper's perspective, or invigorate, I suppose, from the carrier's perspective,
Mm-hmm.
the tightness of the market and the strength in future freight rates. But that was already happening. We were already looking at truckload employment down to the lowest level in over 10 years,
Mm-hmm.
really before any of those factors had any chance to take a serious role. And if you look at let's break a few of those down. The only thing that we have really good visibility into the actual data behind is English language, and we have very good visibility into that because that's very transparent. It's collected at the roadside. It's reported essentially on a daily basis, which we kind of collect that way as well. And to this point, since the end of June, where this became an out of service item, we have eliminated some 16,000 plus drivers who presumably are gone, although I suspect some of them are going to come back again until they get caught. But that's, you annualize that and you get to roughly 30,000 drivers a year. And that sounds like a lot, but that's not going to be on its own a market moving change. What it is doing is pressuring, the trend that we already said. So, if we weren't already dropping capacity, I don't think it would really be making that much difference.
Okay.
The other element that I think we have some insight into is non-domiciled CDLs, because we do have the FMCSA estimate that their rule will take out, roughly 194,000 drivers. In the final rule, they did throw in a couple of caveats that complicate that. One is initially they thought it would take out 194,000 over 2 years. Now they admit that it's some of these CDLs have 5-year terms. On the other hand, they also point out that this is based on what they say properly issued uh, non-domiciled CDLs. And the other thing that is takes a little bit of knowledge is they're going after roughly half the states uh, to basically say your non-domiciled CDL program is non-compliant, and presumably that means they are going to potentially shut down and revoke CDLs issued by those. You have a lot of other states, especially red states, that are just voluntarily giving up their programs altogether. Um, but how many of those 194,000 are Class A CDLs even, who are involved in over the road? Still a lot of unknowns in that, and there's still litigation
Yeah.
going on over that. So a lot of those are a little bit, opaque. And the CDL mill thing, sure, that's going to take some capacity out. What we don't really know though is, how many drivers we're talking about. They're talking about how many CDL programs are shutting down. We don't really know how many drivers were coming out of those programs. I suspect that some of those programs were probably very low volume,
Mm-hmm.
which is why they weren't complying with the rules in the first place. So, is that going to be a real, drawback in terms of being able to add capacity? Unknown. And then finally, the ELD, if they really do clamp down on ELD standards, that's probably going to have a substantial effect, because a lot of drivers out there are using, self-certified devices that are allowing them to drive more than they should be able to drive.
Hmm.
So if you can drive 20% more, let's say, than you normally, should be able to, well, then you're essentially 1.2 drivers. You're not one driver. So
Yeah.
that's a significant thing. But, other than the English language, we really don't have a sense, and that one alone is not really a game changer.
Okay. Okay. Interesting. So, Avery, we're nearly 4 weeks in now to the Iran conflict. Obviously, we've seen significant uptick on diesel fuel prices. That seems to be the real headline here in terms of how the Iran conflict is impacting trucking. Uh, can we talk a little bit about the diesel impacts? I know there's a fuel surcharge recapture recovery baked in there on the carrier side, but on a general level, how is the war impacting trucking operations, including the rapidly increasing price of
Sure.
fuel?
Well, let's really focus on that one because we honestly don't know yet whether the war's introduction of uncertainty is going to affect either the industrial sector or the consumer sector very much. And the history is kind of unclear on how wars really affect domestic economy. And in fact, if anything, we do know that there's going to be a little bit of a bump in the industrial side just to replace the munitions that are being used up. So
Hmm. Hmm.
so let's just put that aside for the moment, and let's just state that it's probably not going to accelerate any economic activity in the near term. Whether it takes away from is another question. Let's focus on diesel, fuel prices. So a couple of things is yes, carriers of size who are operating in a contract or route guide environment do have surcharges. So those are going to flow to shippers. Now, before I even get to the, spot market where that's not the case, we do
Hmm.
also have to recognize that, typically the surcharge is paid when the freight bill is paid, which is going to be, some weeks after the load is hauled.
Yes.
And that means that, in a lot of cases, these carriers are footing the cost up front and, are going to get reimbursed later. Well, these costs are escalating. As we speak, we're 3 weeks into the diesel price surge, and it's just under $1.48 in 3 weeks. That has never happened before. Even in 2022, it went up a $1.15 in 2 weeks and then went down 12, roughly 12 cents the following week.
Yes.
And so, this is an unprecedented situation. However, it's also a different environment in the freight market. So, in 2022, in early 2022, while yes, the market was coming off extreme highs in 2021, it was coming down, it was cooling. And what happened, it was in the early stages of cooling to the point where I think, if we were to go back 4 years and look at what people were writing about and talking about, we probably weren't talking about that it was cooling. That's something we didn't know it necessarily at the time. The reason that's significant is that carriers were still trying to hire drivers right and left to meet what they considered to be a very strong market. And meanwhile, you had, diesel or spot rates starting to decline, and you had this unprecedented at the time surge in diesel costs. What that did is that forced a lot of small carriers out of business and sent their drivers to larger truckload carriers who immediately got snapped up. And if you look at
Yeah.
the hiring there, that's in a large degree what triggered the conditions that the trucking industry has been dealing with for the last 3+ years.
Hmm.
This time is different. There isn't a lot of recruiting going on. The most recent payroll data shows that carriers have been, dropping drivers. And even if they wanted to immediately hire drivers, a lot of them just don't have the infrastructure to do it. And then on the other side of it, spot rates are going up. 4 years ago, spot rates continued to fall for dry van and refrigerated, even though, diesel prices were soaring. Now, you're not getting 100% fuel recovery, but you're getting pretty close to that in the spot market. And again, the spot market, it typically is an arena where the carrier does not get a fuel surcharge, typically.
Okay.
So how that's all going to play out is interesting. It's going to take some capacity out. Clearly, there are going to be carriers that cannot weather, 3 weeks at, at almost a $1.50 increase in diesel. But it's also clearly helping out everybody else. So it's adding. 4 years ago you could argue that that surge in diesel prices ultimately was deflationary for rates because it sent up capacity in the contract side of the market. This
Hmm.
time, I think it might have the opposite effect. So from a shipper's perspective, it becomes kind of the worst of both worlds because you get a high fuel surcharge and you get a little bit of extra capacity loss that probably will drive up core freight rates to some
Hmm.
degree. Although
Absolutely.
they were already rising, but still, I think it will add to it.
No question about it. And that's a good segue into rates and pricing, Avery, when we look at what's going on within both the spot and contract truckload markets. And obviously, that's across different segments too, as we're looking at dry van, flatbed, and refrigerated as well. But fuel is obviously a big piece of that rate puzzle. Uh, how how would you describe the rate environment on a general basis when we have all these different factors worked in here?
Sure. So, we generally, when we look at rates, we generally do so excluding fuel, because it helps us isolate the kind of the fundamental dynamic.
Yeah.
And even excluding fuel, the year-over-year increases this year have strengthened very sharply in terms of our forecast. So we're now looking at, overall, what we call total truckload rate increases. And by that, what we do is we report essentially a blend of spot and contract based on what our assessment of the market is, which is more or less in a normal market, a 70-30 split contract to spot.
Hmm.
That
Hmm.
obviously was a little different. If you go back to 2021, it was probably closer to 60-40 and maybe even 50-50. But in a 70-30 split, we're looking at probably double digit year-over-year increases for dry van, refrigerated, and flatbed. Maybe not quite that for flatbed at this point looking, but certainly close to that. The spot element of that, because spot does tend to go, ahead of contract, is probably more like double that. Now the base is low, or as low as it typically has been for years, but that is still a pretty sizable gain. In considering that really you haven't seen any strength in the market since 4 years ago, really. I mean, if you go
Yeah.
back, by the time you get to the fall of 2022, the spot market has normalized and it essentially has acted that way all the way up until late last year, where we first started to see some inflection in the market, which we
Okay.
think is primarily capacity driven with a little bit of, some kind of disruption happening.
All right. Great description there. A couple more quick ones here, Avery. And you had referenced front loading or pull forwarding earlier in our conversation as related to tariffs and import activity and subsequently shipment count. Looking at tariffs, obviously already year to date, it's been an interesting year with the Supreme Court reversing the White House's push to implement the IEEPA tariffs. Um, and also, there's a whole lot of other things going on there too. Tariffs really, I mean, put before 4 weeks ago with Iran, I mean, it was all tariffs. It felt like it was all tariffs all the time
Sure.
within freight transportation. And obviously, while perhaps not to the same level or degree, attention wise or headline wise, it's still there, right? I mean, so I'd just be really interested to get your take on the impact of tariffs as it relates to sort of and its uneven trade flows, if you will, and how that impacts or affects the over the road motor carrier market.
Sure, it can be difficult to isolate all that because
Yeah.
in some degree it does depend on kind of, are you dependent on exports, imports, or whatever. There's a couple of things we can't escape. One is that costs are going up, right? I mean, there's no way around the idea that tariffs add to pricing. Now, does it add to escalating pricing, like we saw in 2021, 2022? Maybe not. But it certainly does help put a floor on inflation, which clearly we have seen. And that's, not good for consumption. It certainly is adding to the cost of manufacturers. Aluminum pricing is at, all-time high,
Hmm.
which, almost everybody predicted. If you slap a 50% tariff on imports, number one, that obviously goes up, and then also domestic pricing is going to go up too. It would be a breach of fiduciary responsibility for makers of domestic aluminum not to raise their prices. So I'm going to throw out something that might sound counterintuitive here, which is that this had the Supreme Court ruled the other way, it might have actually calmed things down. And that sounds well, that doesn't make any sense. And the reason I say that is at least we knew what we were dealing with, right? At
Yeah.
least we had these tariffs, they were in place, they were being collected, we knew what was going to happen. Immediately thereafter, largely replace those with the Section 122 tariffs, right? So we have 10% tariffs in place globally, a threat of another 5%, which has not panned out. Now, those technically will be in place only until I think late July
Yes.
before the
Yeah.
Congress has to but that adds to a further uncertainty, right? Is Congress going to, is he going to be able to force Congress to go along or not? And even if he doesn't, is he going to just say, that's fine, I'm going to reinstitute him and then force people to go to court? Because that seems to be, something that they're more than happy to do.
Right.
The other
Right.
element is that we're substituting Section 301 tariffs for the emergency tariff. So, there's two new initiatives, one on child labor, one on, chronic underutilization of manufacturing capacity as a unfair trade tool. That all adds uncertainty. And then the biggest one of all, especially for trucking, is where is the USMCA agreement going? At this
Yeah.
point, there hasn't really been anything definitive. And yet, you ask any shipper out there, they're all expecting something, right? It's like everybody's on pins and needles. Like, when is he going to pull the trigger? Because we know he's going to, but wait, maybe he won't. So things between the war and the tariff situation actually becoming less predictable after the Supreme Court decision. Now, I'm not arguing that the Supreme Court decision was wrong. I personally think it was the correct decision, but I think all of that just adds more uncertainty, and then just sort of the generalized angst over what might happen with the USMCA agreement, is all kind of keeping a little bit of a lid. And, we have seen in the very latest data on manufacturing, maybe some indication that that little recovery has petered out. Now, I'm not going to say that's our forecast, but because it is only 1 month, and it's one
Yeah.
month, based on a winter month, which tends to be a little iffy in terms of seasonal adjustments. But there is an argument to be made that, maybe we are, stifling the recovery that otherwise would have happened. So that's got us a little bit concerned, frankly.
No, 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 no doubt about it. They're big ticket issues, and they're going to be requiring a lot of attention and focus as the year moves on, to say the least. Avery, just as we wrap up, um, what advice would you have for for shippers that use truckload services and LTL services, etc. Um, uh, for navigating this market? Or what are the things they really need to stay on top of, the things they need to be watching, benchmarking, what have you? What would be some of the things that you could offer up in terms of guidance or advice?
Well, it's a good question. I don't know if I have a great answer given all the things we talked about, but I think that, you know, I think that the thing I would point out, and I normally hesitate to suggest people be too reactive, right? I'm usually in the position of saying, look at the bigger picture. Don't be too reactive to near-term signals because those can go south or north, you know. But the reality is, I don't know that you have an option otherwise right now. You know, we've been in an environment where for 3 years you could pretty much just do whatever you were doing, and you weren't going to see any significant increase in cost, and you certainly had no problem with capacity.
Yeah.
Um, so you know, if there's an upside for shippers, and believe me, this is not even a silver lining to a dark cloud. It would be maybe a pewter lining to a dark cloud. You know, from what is going on, is it is at least giving us a signal about where the market is going, right? Because, you know, had diesel prices shot up, you know, $1.50 in 3 weeks, and you know, rates not changed, then I think shippers could be able to say, okay, this is strictly a, you know, this is strictly a fuel cost issue. There's still plenty of capacity in the market. We really don't have to worry about anything. That didn't happen. You know, again, as I said earlier, there hasn't been 100% fuel cost recovery, uh, and nor I think would we expect that to have been in the spot market, but
Hmm.
we've come close enough. And I think that shippers, especially dry van and refrigerated, but frankly, flatbed as well, um, need to really think that, okay, this is potentially, you know, another, if not 2021, another 2018, you know, or something like that,
Hmm.
and
Hmm.
need to start looking at what, you know, what types of things they can do to, you know, lock in capacity, lock, you know, and you know, lock in rates. And as we all know, those are only going to be as good as the market. But, you know, what else do you do, right?
No,
You've got
for
to try.
sure. Okay. No, great advice. Look, Avery, that brings us to the end of our allotted time for today's podcast. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to say thanks for joining us once again. I believe it's your third time on the podcast. I'll have to double check that. But thanks for
Yeah, it's at least the third time.
yeah, I think so. Yeah, it might even be the fourth. I honestly can't recall. But in either way, thanks again. We covered a lot of ground today, and there's obviously a ton going on in the market. Um,
Yes, there is. And
yeah.
yeah, enjoyed the opportunity, Jeff.
Yeah, no, always. And for those listening in, please go ahead and check out FTR online. Just go to ftrintel.com. There's lots of great information, data, and resources there. And also, Avery has a really good LinkedIn presence. So please go ahead and connect with him on LinkedIn. It's just linkedin.com/IN backslash Avery Vise, that's all one word, Averyvise, followed by another backslash. And for those of you on Twitter, please go ahead and give Logistics Management a follow. Simply go to @LogisticsMGMT. And also, please go ahead and subscribe to the Logistics Management Podcast. If you're not already subscribed, just look for the Logistics Management Podcast wherever you get your podcasts, and it'll come right up. Thanks, everybody, and have a great day. We'll catch up with you real soon.